We're going to look at the statement of cash flows using the direct method. I have another video in which we use the indirect method, which you can watch separately, but this is going to focus on the direct method. Now notice it says the only difference between the direct method and the indirect method is how we prepare the operating activities section. Investing and financing are identical under both methods. So this is going to be focusing exclusively on the direct method. Now, when you prepare the statement of cash flows using the direct method, the funny thing is you also have to do the indirect method. I'm not going to do that in this video. Again, that's in another video. I'm just going to do the direct method. So let's take a look. There are 5 accrual-based figures that have to be converted to the cash basis in the operating activities section. We have to convert revenues to cash receipts from customers. We have to convert cost of goods sold to cash payments to vendors, and we'll assume that is for inventory. Convert operating expenses to cash paid to vendors for operating expenses. Now, it's possible on an exam that instead of seeing one number called operating expenses, you might see salaries expense, or wages expense, utility expense, insurance expense. Those are all operating expenses. And so we'll do an example which I think you'll see can address that. Then we have to convert interest expense into cash payments for interest and convert income tax expense to cash payments for income tax. And you'll see patterns develop here. So hopefully this is something that you'll find to be manageable. All right, so let's take a look at converting revenues to cash receipts from customers. All right, revenue for the year is $600,000. On January 1st, my beginning accounts receivable is $50,000, and on December 31st, my ending accounts receivable is $40,000. It's possible you could also have unearned revenue. And so I'm including unearned revenue in case you see an example where you have both receivables and unearned revenue. More than likely, you're just going to see accounts receivable. But again, we'll do both. All right, first, let's take a look at accounts receivable. So the beginning balance of $50,000, remember, that was last period's ending balance. So there's a couple of different ways we can look at this. First, if we look at the beginning balance, think of the journal entry that created this. Debit accounts receivable, credit revenue. Well, that relates to revenue from the last period. That receivable, the beginning receivables, will get collected this period. If we look at the ending accounts receivable, debit AR, credit revenue, that $40,000 is already in the current year revenue, but it will not be collected until the following year. So remember, we're converting revenues to cash collections from customers. So what we're going to do is we're going to add the beginning AR to revenue, and we're going to subtract the ending AR from revenue. And that's going to give us part of the cash collections from customers. Now, you may recall, if you saw the indirect method, that when the AR balance decreases from beginning to end of the year, it's because we collected cash. So you can simply look at the difference, and if it's a decrease, we'll add the decrease, and if it's an increase, we would subtract the increase from revenues, and again, we'd come up with the same number. If we have unearned revenue, again, you got to think of the journal entries that create these balances. Beginning unearned revenue, we debited cash, credited unearned revenue, okay? And then this year, as we earn the revenue, we would debit unearned revenue and credit revenue. So that unearned revenue, the beginning balance, we collected that cash last year. However, it'll become revenue this year. Ending unearned revenue, debit cash, credit unearned revenue. It's not revenue from this year. However, we collected the cash this year. It'll become revenue next year, but we're not analyzing next year. So, to help convert revenues to cash collections from customers, if we have unearned revenue, since I collected the unearned revenue, the beginning unearned revenue, I collected that last year, we're going to subtract that amount. Because that amount will be in revenue, but it won't be in cash collections. And ending unearned revenue, we collected it this year, it'll become revenue next year. So it's not in revenue, but we collected the cash this year. We're going to add it since we collected the cash this year. Okay? And so you have to really think this through. It's not necessarily intuitive. You really have to kind of walk your way through the process. Now, just like with AR, there's an alternate way to look at this. If unearned revenue increased, it's because we debited cash, credited unearned revenue. If it increased, we would add the increase, since that was a cash collection. And of course, if it decreased, we would subtract the decrease from revenue to convert to cash collections. So remember, in any of my videos, if I start getting ahead of you and you're saying, whoa, what's going on here? Hit pause, hit rewind, watch it again, stop, think it through. I'm a believer in putting it on pencil and paper. I love T accounts, they're great visual tools, and don't keep going until it makes sense to you. Okay? So we just converted revenues to cash collections from customers. Now, if you have other sorts of cash coming in, for example, dividend revenue or interest revenue, you would analyze that as well. But typically, those amounts are usually not going to be included in the examples. But again, if they are, you would include them. Okay, because dividend revenue and interest revenue go into the income statement. They're part of revenue. The next thing we have to do is we have to convert cost of goods sold to cash payments to vendors for inventory. And it's a two-step process. And I'm going to show you kind of an alternate approach to step one in just a little bit. All right, so our cost of goods sold is $300,000. Beginning inventory $40,000, ending inventory $50,000. And we have accounts payable, beginning balance $30,000, ending balance $20,000. So there are two steps. First, convert cost of goods sold to purchases of inventory. And then step two, convert purchases of inventory into cash disbursements. Remember, this is the statement of cash flows. Cash flowing in, cash flowing out. So this is going to be an outflow. All right, step one, convert cost of goods sold to purchases of inventory. Again, look at the balances beginning and ending and think of the journal entry. The beginning balance was last year's ending balance. Debit inventory, credit cash or accounts payable. But the important thing is that inventory, the beginning balance, was purchased last year. It's not part of this year's purchases. However, okay, that's going to get used this year and it's going to go into cost of goods sold. Okay? Ending inventory, debit inventory, credit accounts payable. Okay? So that was purchased this year, but it's not going to become part of cost of goods sold until next year. Okay? So we're going to subtract the beginning inventory since it was purchased last year. It wasn't purchased this year, it was purchased last year, so subtract beginning inventory, and we're going to add ending inventory since that was purchased this year, but it won't become cost of goods sold till next year. Okay, so by doing that, we're going to convert cost of goods sold to purchases. Now, the other way you can do it is look at the difference between beginning and ending balance. If the balance increased, it's because we debited inventory, which means a purchase, crediting accounts payable. We would add the increase to get to purchases, and if it decreased, we would subtract the decrease from beginning to end of the year. Okay? Part two is to convert purchases, which we just calculated, into actual cash disbursements. So the accounts payable journal entries, beginning, debit inventory, credit accounts payable. We should do it this way so you can see, here's my debit, here's my credit. That was last year, right? Beginning balance is last year's ending balance. Okay? So that purchase was last year. However, we're going to pay it this year. That'll become a disbursement this year. Accounts payable ending balance, debit inventory, credit accounts payable. That was purchased this year, but it's not going to get dispersed until next year. Okay, so to convert purchases to actual disbursements, since we're going to disperse the $30,000 this year for last year's purchase, we're going to add that to disbursements, or to purchases, excuse me, and it'll become disbursements, and we're going to subtract the ending accounts payable. Since that was purchased this year as part of purchases, but it won't be a disbursement until next year. Alternatively, we can look at accounts payable and say, okay, if it decreased, it's because I debit accounts payable, credit cash. So a decrease would be added to the disbursements and an increase would be subtracted. So again, hit pause, think it through. What I want to do is go back to the purchases for a moment, and you may find this analysis more to your liking. Here is the cost of goods sold equation, which hopefully you're familiar with. Beginning inventory plus purchases made this period equals cost of goods available for sale minus ending inventory equals cost of goods sold. Hopefully that sounds familiar. If we rearrange that formula, we get to purchases. So watch and look at the numbers. Cost of goods sold plus ending inventory equals cost of goods available for sale, and then cost of goods available for sale minus beginning inventory will give us purchases. So you can look at it that way. We're really doing the exact same thing. Notice that to get from cost of goods sold to purchases, we added the ending inventory and we subtracted beginning inventory, which is what we did a moment ago. Here, this kind of gives you a slightly different visual. Okay, so again, 2 steps to convert cost of goods sold to actual disbursements to vendors. First, we convert cost of goods sold to purchases. Then we convert purchases to actual cash disbursements to the vendors relating to inventory. That's the second step. Step 3, convert operating expenses to payments for operating expenses. Now, it's possible you'll only have 1 or 2 or maybe even 3 of these accounts. You might have wages payable in there. Okay, and so I picked rent, prepaid rent, and utilities payable. And we're kind of dipping back into our adjusting journal entries a little bit. So for this period, my operating expenses are $100,000, and we'll analyze prepaid rent first. Beginning balance $30,000, ending balance $40,000. Okay, now let's think of the journal entries. When you debit prepaid rent, it's debit prepaid rent, credit cash. Well, that took place last period. Okay? So that disbursement took place last period, and then think of the adjusting journal entries that will take this period. Okay? Debit insurance expense, which is an operating expense, credit prepaid insurance. So the beginning balance was dispersed last year, it'll become an expense this year. Okay? So since it was dispersed last year, we're going to subtract it from operating expense. Ending balance, $40,000. Debit prepaid insurance, credit cash. It was dispersed this year. It won't be part of operating expenses until next year. So we're going to add the ending balance of prepaid rent to operating expenses. Okay? So subtract the beginning balance, add the ending balance. Okay? In this case, prepaid insurance increased. Debit prepaid insurance, credit cash. So if it increased, we would add the increase to get to disbursements. And if it decreased, we would subtract that. Let's look at utilities payable. And that could be wages payable, okay? What we call accrued liabilities. Accrued liabilities are also called accrued expenses. They're kind of one and the same. Since you debit an expense, you credit the liability. All right, so the beginning balance for utilities payable, $45,000, was last year's ending balance. Debit utility expense, credit utilities payable. So it was an expense last year, but it's going to get dispersed this year. Okay, so we're going to add the beginning balance. Utilities payable, ending balance, debit utility expense, credit utility payable. It's in operating expenses this year, but it's not going to get dispersed till next year, so we would subtract the ending balance of utilities payable. Or you can simply look at the increase or decrease from beginning to end of the year. If it increased, it's because we debited utility expense, credited utilities payable. It's in the expense, but it was not dispersed. We would subtract the increase, and we would add the decrease to the expense to derive disbursements of cash for operating expenses. Okay, so look at this at your own speed, run the numbers, think it through, think of the journal entries. I kind of like the first approach better myself. Because I can think of the journal entries and say, okay, when's the cash coming in or going out, which period? And that helps me decide if I should add it or subtract it. Convert interest expense to payments for interest. Okay? Interest expense, $50,000 for the year. Beginning balance of interest payable, $15,000. Ending balance, $20,000. Okay, here we go again, same process. Think of the journal entries for interest payable. Beginning of the year was last year's ending balance, debit interest expense, credit interest payable. So it was an expense from last year, it's going to get dispersed this year. So we're going to add that beginning balance. Ending balance of $20,000, debit interest expense, credit interest payable. It's included in interest expense this year, but it's not going to get dispersed till next year. So I'd subtract the ending balance. Okay? Alternatively, I can look at the difference. In this case, it increased. So a $5,000 increase, debit interest expense, credit interest payable. Included in interest expense but not dispersed, I'd subtract the increase and I would add the decrease if it were a decrease. Okay? And guess what? One more step to go and it's identical. In fact, all you do is swap out the words interest and put in income tax for both income tax expense, income tax payable. It's identical, the process, but we'll do it anyway. Income tax for the year, $30,000. Beginning income tax payable, $15,000. Ending income tax payable, $20,000. Beginning balance was last year's ending balance. Last year we debited income tax expense, credit income tax payable. It'll get dispersed this year. Ending balance, debit income tax payable, income tax expense, credit income tax payable, right? So it's included in income tax expense. It's going to get dispersed next year. So I would add the beginning balance, I would subtract the ending balance. Or if you just want to look at increase or decrease, since it increased by $5,000, debit income tax expense, credit income tax payable, the increase would be included in income tax expense, but it wasn't a disbursement, so we would subtract the increase, or we would add the decrease to income tax expense, excuse me. Okay, so we've just converted these 5 numbers from accrual basis to cash basis. Let's look at a summary. Okay, revenue was $600,000, and if you go back to slide 1, you'll see that our cash receipts from customers was $630,000. Cost of goods sold was $300,000. Cash disbursements to vendors, $320,000. Operating expenses, $100,000. Cash payments for operating expenses, $120,000. Interest expense, $50,000. Cash payments for interest, $45,000. Income tax expense, $30,000. Cash payments for income tax, $25,000. And revenues minus expenses gives you net income of $120,000. Cash receipts minus all those cash payments gives you cash from operating activities of $110,000. Okay? Now, on the statement of cash flows, if the cash from operating activities is a positive number, then we typically say cash provided by operating activities. And if it's a negative number, we would say cash used by operating activities. And you do the same thing for investing activities and financing activities. Okay? So remember, the only difference between the direct method and the indirect method is how we prepare the operating activities section of the statement of cash flows. Everything else is the same. Okay, so you're going to have 3 numbers. The net increase or decrease, positive or negative from operating activities, investing activities, financing activities. You're going to add up these 3 numbers, and it's going to be our net change in cash. It's either a positive number or a negative number. Okay, so that's the net change in cash for the year. Then at the bottom, you show the reconciliation. You're going to show beginning cash. Okay, you'll have the net change, and that will give you ending cash. So beginning and ending cash come from the balance sheet. And that net change, which we just calculated, explains the difference between beginning of the year cash on the balance sheet and end of the year cash on the balance sheet. Last quick comment is that in the event there are any transactions that are what we call non-cash investing or financing activities, for example, purchasing land and issuing a note payable, or leasing equipment, where you debit the leased asset, credit the lease liability, you have a separate schedule of non-cash investing and financing activities. That's a little outside of our purview today, but just wanted to mention it. And there you have it.